What's going on, guys, and welcome on into the channel. So we're talking about the Strangle options strategy here in today's video. If you guys recall, I believe recently we talked about the straddle options strategy. So we're going to be talking about this strategy. Now, the reason why we talk about it is because you don't have to worry about the direction. You can go up or down. For example, we're looking at Apple stock right here. Let's take a look at the daily chart on this bad boy. So right now, I would, if I had to pick a direction, I would pick, bullish. I'd pick to the upside. So I would think Apple pushes on up. However, maybe there's a stock, maybe there's a situation where I'm like, Apple's at a crucial point right here. Either it's going to break through resistance or it's going to get rejected hard and it's going to fall back off. Or we're at a tipping point in the market. We got maybe a Fed meeting coming up. Maybe there's, an election coming up. There's something coming up that could sway the markets, significantly up or significantly down. And I want to make sure that I'm going to be able to play both sides and I'm there for the volatility, but I just don't know which direction it's going to be. And I don't want to get caught picking the bull side and only for things to fall off to the downside and for me to lose everything that I put into that option trade. Now, of course, you can hedge yourself by buying a call and buying a put, but with this strategy, you can kind of do it all together in one. And so we're going to talk about that. We're going to talk about the risk reward, talk about what you need to know. And then, of course, on the Webull platform, it's going to show us very, very nicely how this works, your break-even points, your max loss, your max profits. So you're going to know your numbers going right in. You don't have to worry about that stuff. You'll know, write them down, take a screenshot so that you would know exactly where the stock that you're trading has to go for you to make money, lose money, break even, all of that. Now, of course, you don't have to use a platform like Webull. We'll walk you through how this works and what you're doing essentially. But we'll leave a link down below in the pinned comment and description box if you want to get 2 free stocks when you sign up and deposit with this platform. It's free money, so take advantage of it if you are new or if you haven't taken advantage of it. It's up to you, right? So here it is. We're looking at a Strangle on Investopedia. This is going to give us a good definition of how this starts and how we can dive into this. So we want to hold a position in both a call and a put, okay? Now, we're going to use different strike prices. So if you guys go back to the straddle, we actually use the same strike price. Now, here we're using 2 different strike prices, but we're going to have the same expiration date on that stock or asset that we're trading. And, like we were just mentioning, if you think we're going to see a pretty big move, but you're not sure which direction, this could be a good strategy for you. However, though, the downside here, which I want to talk about as well, if we don't get that move, this could hit your max loss, and this could easily be a loser. So you need that volatility, you need that move. If we're in a market that's super choppy and it's like not really moving and stocks aren't making big moves, this is not the strategy that you may want to use. Now, maybe for your individual stock, there's a certain event catalyst upcoming, and this could be a good strategy. But if we're, looking at a stock or a market condition where things aren't making big moves and we're kind of chopping along and consolidating, this isn't probably not the best strategy. So make sure you understand that risk going in. I want to make sure, you're aware, because right now, this day and age, right, you see all the videos and everything. Everyone's talking about this and that and this 10x strategy and this no lose strategy and this strategy. You could technically make a video on this and say it's the no lose strategy. Well, yeah, it's a no lose because, okay, the stock goes up, you make money. Stock goes down, you make money, but you still could lose if the stock stays in the middle of, your range that you kind of needed to break out of. So hopefully this video is helpful. If you get anything out of it, consider subscribing, consider that thumbs up button. We try to post once per week here, keeping it educational, keeping it strategy based or tutorial based, something along those lines. Okay, let's go back to our platform and I'll zoom in once we get to the option chain here. So we're looking at Apple and we're saying to ourselves, let's just say that if I zoom in a little bit more here on the Apple chart, let's just say that I think Apple is either going to fall back down and go big down because there's some big Apple event coming up. Maybe there's an Apple event, right? I think Apple's going to either be a sell the news and fall off, or Apple's going to rebound. And I think Apple, in the next month or a couple of weeks is going to be back up into the 150s and maybe go for all-time highs and make a big run, right? Let's say that's my thought process going into this trade, or there's, an election, or there's a big catalyst coming up, or something's happening, right? I'm like, all right, let's go to the option chain. And this is where I'm going to start to zoom in so we can see this a lot better. Okay. Now, there on Webull, you can go to the single option strategy, right? And through here, these are just going to be single options. So the puts on the right-hand side, calls on the left-hand side. Now, if I want to go to my option strategy, I can actually do that over here on the left-hand side where it says single. Click on that drop-down menu, and then I can go and we're going to talk about, if you're watching this video, we've probably covered a bunch of these, if not all of them. When we put it out, there's a lot more we had to cover. But if you're watching this after the fact, a couple weeks, we've probably covered a lot of these strategies, so definitely check out the channel, check out the playlist, option trading playlist, and we probably have a video going over all these strategies. But in this case, guys, we're looking at a strangle. So you want to go to the strangle right here, and it's going to simplify things for you. Okay, so we can adjust the width, which I'll explain what that means in just 1 second. We can adjust that, but I think the easiest way to do that is once we have the graph pulled up. So I'm going to pull up the strangle right here, and let me move this out. Well, I'll leave it for the 15th, at least when I'm filming this video, for the purpose of this video, but this could be, the time frame is up to you. So if we have a catalyst upcoming for Apple that I think is going to happen before the 15th of October when I'm filming this video, then I want to make sure that my expiration date is after the catalyst, or it's after the the date or the rough time frame that I'm looking for this move. Okay, so if I think Apple's going to be volatile through the end of the month, then I might want to go here and I might want to move this out to, let's say, early to mid-November or a month or two out, just to give me some time for this to happen. Now, of course, it's going to potentially be more expensive, and it's potentially going to alter your break-even points and your max loss and your max profit points, but that could be something you want to take into account. And there's probably an easier way to visualize this. And I think the best way to visualize is on the Webull graph. So we'll talk about that here in just 1 second. But I did want to show you guys this. Going back to Investopedia, I wanted to show you guys this. Why? It's because this is going to be really helpful to see what we're talking about. So our P&L is on the left-hand side here. And then if you go across with the y-axis, go back to high school, middle school, whatever. And then if you go across the x-axis, that's the stock price, okay? So we could be looking at a strike price somewhere in this range, and essentially for us to make money, the stock needs to go way out to the right or way out to the left in terms of, making a move in the direction, right? Now, we have a pretty decent way and a decent fight, I want to say, from, where this line crosses the x-axis right here, our P&L line. That's our zone that we got to kind of fight. We need that stock to push up or down. We can't have it sitting in this zone, okay? That's what you need to understand, is to visualize kind of the direction or the move we need. And now we'll show you guys a graph on Webull and how this stuff works, okay? So what we're doing with this strategy is let me go here and let me go for these. The 145 by 146. Let me click on this. Let me go control buy. Now this pops up. Let me actually make this nice and big so we can see this really well on our Webull platform. Okay, so here we go. Now, what we have right here, actually, let me see if I can make this. Boom, it's its own thing now. Awesome. So I'm going to just go to 1 in terms of the quantity so that, we can see this with just one, with one option, buying a call, buying a put. But again, guys, we are doing the long strangle option strategy here. So what this means is we're buying a call and we're buying a put. Webull's going to, for this, they're going to give you a limit price. This is actually factoring in both the call and the put price for Apple, and it's adding them together. That's the limit price that it's given me. This may need to be adjusted if we go back to the options chain really quick, and I go back because we're looking at the 145 and 146 strike prices, and we're going to be talking about the 145 puts and the 146 calls, okay? So we go back here, I go to single option. These are the twos. The 145, we're talking puts. They're going to be going for looks like 167, and the 146 calls, about 75 cents. So you add those two together. Now, if you're looking at options that have very low open interest, very low trading volume, that spread could be pretty large. So I would recommend that you're doing this with stocks that trade a lot of volume and stocks that have a lot of, or at least option contract strike price, right? That has a lot of open interest, that has a lot of volume, so you can get in and get out, right? So let me go back again here. Go back to our strangle, go back to our order entry. It's all set up. Now, on the bottom left of this, we have a graph option. I would highly recommend you click on the graph. Now, guys, we can see it. It looks like that picture, but we can see it very easily. This is where I think it's really cool. So we're buying the 145 put and we're buying the 146 call. So if we go over 146 to the upside pretty big, we're going to make money. If we go below 145 down pretty big, we're going to make money on that put. The put will be in the money if we're under 145 and the call will be worthless, and the call will be in the money if we're over 146 and the put will be worthless. So that's kind of what at least the fundamental, side of how this is going to work. Now, you're going to want to close this out because unless you expire in between these, this would be your max loss, right? We expire between 145 and 146. It means the stock price of Apple by the 15th, by the expiration of this option, of these two options, is in between the put and the call, which would mean that the call's worthless because we're below that, and the put's worthless because we're above that, so you hit your max loss. So your max loss here, guys, is what you pay on the long strangle option strategy. Whatever you pay, that's your max loss. So if you're tossing in a couple grand and you're buying a couple contracts here for Apple, for example, if I want to up this to, let's say, 10 contracts, then my max loss, it's going to cost me right here $238 or $2.38 per one of these strangles, right? Which is essentially buying two options. It's going to cost me $238 for, one of these. I multiply this $238 by 100, okay, 238, and then I have to essentially do that 10 times, okay? So we have to make sure we take that into account, which would mean the total price here is going to be $2,380 if this is where I set my limit order and it fills at this point. Okay, let's go back to 1 so we can see this very easily. Of course, you guys can scale this up, scale this down, whatever account size you have. Just make sure your risk reward's in line. And we always like to say, you better be targeting a decent, move up or down so that your risk reward is in line here. Now, okay, our width is 1. What does this mean? And why is this important? Well, we're going to actually show you what this means. This means that the width between the put and the call is $1, right? That's what it is. I can change this to 2. I can change it to 3. Whatever I want to do. It doesn't really matter. It really, what matters now is going to be calculating our, our risk reward, calculating our price targets, our profit targets, things like that. So let's say I change my width to 3. That just means we have a $3 gap in between the put that I bought and the call that I bought. So this gives us essentially a $3 range where we could hit our max loss. So if Apple expires by the end of this expiration between 145 and 148 now with a width of 3, that means our max loss is in that range. So we got a pretty big max loss, but now to the upside, if we get that big move in our direction, either way, we could make a good bit of money. So just make sure you mess around with that and see. In this case, our break even to the upside with a width of 3, let me zoom in a little bit more. Our break even to the upside would be Apple at 149.90, and our break even to the downside would be 143.10. This is also going to cost me $1.90 per strangle. So it's going to be a little bit cheaper than what we were looking at before. But again, there's more room for us to hit our max loss. So we got to make sure we're aware of that. So now let's go back to a width of 1, and I'll show you guys where that break even was. So we had a pretty big range. Now our break even here is actually 148.37 to the upside, and then to the downside, it is now 142.63. So that break even has changed. It's actually come down a little bit with a smaller width in this situation. Okay, so now what do we need? We need Apple to finish up, looks like right here in this case, up over the 148.37 or below 142.63 in this example, in this case, for us to make money. If we look to the top right, Apple is trading at 144.52 right now. So we're kind of down to the lower end of this. So if we think Apple's going to go down, we're in a better position to take advantage of this right here because Apple could come down. It looks like right now it comes down about $2, $3. We're nicely into the green and we've made some money. Now, as we hover over this, if we zoom out and hover over this, what we can see is that as we move across, look at our P&L up on the top right here. As I move my cursor to the left, as I move along this axis, which is telling us the stock price right here, that's our P&L. Now, this is telling us our P&L at the expiration based on intrinsic value. So this isn't going to be perfectly accurate when there's still time into the expiration. Why is that? Well, there's because these options are still factoring in volatility, there's time decay, there's a lot of other things that go in. So technically speaking, we could be green on our position if Apple pushes up or down. Let's say today, when I make this trade, let's say by the end of the day or by tomorrow, Apple goes crazy. It may not hit our break-even point based on this graph, but if Apple goes crazy up or crazy down, we could still make money. Why is that? Well, that's because that contract is going to be a little juicier, right? Because we got a big move. So we have more intrinsic value. Let's say Apple moves up to 148, right? At 148, technically, we're still going to be $36 in the red, but we still have time on our put. So our put right now looks worthless because it's 148, but that put will still have some value because there's still time to the expiration. There could be a crazy event, Apple falls down. So we could technically sell that put for some salvage value, some volatility, some time value. And also our call is going to have more intrinsic value because now our call is going to have $2 of intrinsic value because the call is a 146. So $2 move up means that call is in the money by $2 at 148, $2 of intrinsic value plus there's still time until that expiration. So you have to also account for the time and volatility factors of that option. So we actually may be in the green at that point. That's all you kind of need to know when it comes down to it. These are going to be calculating based on intrinsic value because there's really no way to know tomorrow if we get a move of X number of dollars, what exactly that contract's going to be. It's going to depend on a lot of factors. So just make sure you're somewhat aware of that. Now, when I do this, all I want to do is I'm going to go here and click on place order. So for example, if I want to do this right now, I would go here and go to place order. And then it will give me a confirmation. I'll click on buy. And this is also great. I would recommend, guys, if you don't want to screenshot the graph, that you screenshot this order confirmation. Super, super nice. So take a look at this. You can screenshot this and it will give you everything you need to know. And it's saying it's an estimated debit because that's money coming out of your account right now. You're paying $237 right now for one of these contracts. And that means that money is potentially what you could lose. If we expire in between, both of those contracts expire worthless, the call and the put, that's how much you lose. So that's your max risk. You're not going to lose more. That's what you could lose. You could lose less or you could make money. That's what you need to know. And it's the exact same way when you have an option contract to go and cancel that or go and actually get out of that option. All you got to do, go to your positions. For example, I have this JetBlue option that I have right here. I go to my position right here and I would go ahead and click on close and I would sell to close this option contract, set my limit price, and go ahead just like that. Now, again, every situation is going to be slightly different, but you need to take into account the price of the call and the put. So if you're confused, all you have to do, go back to the option chain. You know what put you bought, you know what call you bought or you're about to buy. Go ahead to the option chain, go into the single option, go find those price points, write them down, and you'll know, add those two up. That should roughly be your limit price you set. And just like that, if you want, you could drop or increase your limit price if it doesn't fill right away, depending upon where the stock is moving, or you could wait and it may take a few minutes to fill just because of how volatile things are and a little change in price. But again, it also may not fill. So make sure you're paying attention. If it doesn't fill right away, you may have to go back, check on the price points of those contracts, see if they've adjusted, recalculate your total limit price you're going to need to put in for your buy or sell, and then go ahead and enter that as you see fit. There you guys have it. It was kind of a long explanation, but hopefully this was helpful. Let me know in the comment section down below what other videos you want to see. If you have any other questions, leave them down below. I can make a follow-up video to this as well. Consider subscribing. Hit that thumbs up button if you got something out of the video. Check out our other two channels. We have links down below to those. We have links down below to any other resources, 2 free stocks with Webull. Again, you don't have to use Webull for this. You can do this on pretty much any brokerage platform, but Webull is what we use for this example, and it's very nice and visually appealing when it comes down to seeing your max loss, profits, break evens, all that type of stuff. So thank you guys so much, and we'll see you in the next one. Peace.